In this video, I want to go through the most important topics in the first learning module for fixed income, for the fixed income part of the curriculum at level 1. And that module is called Fixed Income Instrument Features. Now, before we get to the actual features, we'll talk about things like the maturity date, the coupon rate, the nominal value or principal, and so on. There will be plenty of features that we'll discuss in this video as well as the next two. I first of all want to define a couple of things and give you a bit of extra info which is in your curriculum, which may easily be turned into a theoretical question. So when we talk about fixed income instruments, we actually mean instruments of a debt nature. So let me write over here, debt instruments. So inherent in this is a debt relationship. Fixed income is the conventional way of calling these types of instruments because they provide you typically with a contractual fixed level of income, although it may not always be fixed. This is in opposition to dividends, which you receive on shares, which are of course a variable cash flow. Now, debt instruments, therefore, fall into two categories, broad categories. We differentiate between loans and what is generally called bonds. Now, loans are obviously private agreements between a borrower and a lender. A borrower could be an individual person. It could be a company of various size. A lender is very often a bank. Okay, we're not really going to talk about loans in these videos. We'll focus more on bonds, which are securities, meaning they are financial instruments, but ones which are tradable. So securities or bond securities are based on a contractual relationship between the bond issuer, who is effectively the borrower of money, so issuers, and investors or bondholders. And it's this relationship that will be at the core of our learnings in this video and the subsequent ones as well. Now, I told you there are a couple of important points, which are little points, but they may nevertheless be used to create a theoretical question. So let me write important points over here. Just to bear in mind, okay? So in just a moment, we'll talk about who issuers of bond securities are. And you'll see that you probably know this already anyway, one of the big groups of issuers are governments. So the first point is that when governments borrow money, and when governments get debt financing, they are typically financed using bonds. So governments are typically financed by bonds. The exception is loans. They sometimes take loans from supranational institutions like, for example, the World Bank or the International Monetary Fund. So loans from, e.g., example, World Bank. But other than this, or the International Monetary Fund, other than this exception, you'll typically find governments being financed by the issuance of bonds. So they become issuers of bonds. Governments do not issue shares. That hopefully is a point that's quite clear. In order to issue shares, you need to be a corporation. Now, the second point is coming to corporate issuers. So companies. Corporate issuers typically have both shares outstanding, because they issue equity securities shares, as well as bonds, which we'll discuss here. But the point is, they typically have just one or to perhaps, three types of shares. If you've studied the equity investment section of the curriculum, you'll know about the existence of ordinary or common shares, but also preference or preferred shares, and even ordinary shares or common shares. They may come in different classes, Class A, Class B, which give shareholders different rights. But you typically have one or two shares outstanding. But at the same time, you typically have, so let me write, but many bonds, many types of debt securities outstanding, but many debt securities or actual issues. And these issues will be different because they'll have different maturity dates. So different dates when the debt needs to be repaid. They may carry different coupons. That's the interest on the bonds. They may be denominated in different currencies. Some will be secured, some will be unsecured. So these bond issues will have their own specific individual features, which is something we'll discuss later on in this video. Not to mention the fact that not just debt securities, but also different debt instruments. So they also have not just bonds, but also loans taken from, for example, banks. And the third point, which I find a little bit kind of out of place here, but nevertheless, it's in the curriculum, it's in this learning module. So let me write it down. The point is, all fixed income securities or instruments, all fixed income instruments, from the point of view of how they are presented in the balance sheet of the issuer, are classified under liabilities. So are shown under liabilities, which is okay at a certain level of generalization. But, I'm an accountant by training, but also a CFA charter holder, and I know certain debt securities are actually classified partially under liabilities, partially under equity. For example, debt securities which are convertible into equity. Nevertheless, for the purposes of the Level 1 exam, all fixed income instruments are classified as liabilities. So that is funding which needs to be repaid. Okay, that's fine. But this is the point your curriculum stresses. Not all liabilities are fixed income instruments. Implying that if you look at the liabilities section of the balance sheet, you'll find definitely bonds which have been issued by the company. You'll find loans which have been taken on by a company, but you'll also, and those are obviously fixed income instruments, but you'll also find other elements there. For example, trade payables, amounts of money that you need to pay to your suppliers. That's a liability. It's not a fixed income instrument. You'll find things like deferred revenue, or my favorite, deferred tax liabilities. Nothing to do with fixed income instruments, just a way that under accounting standards, we show certain amounts from a balance sheet perspective. Okay, so these 3 points I think are quite important. When I was reading the relevant learning module, I did pick them up. They're not related to anything we'll talk about in just a moment with regard to the actual features, but something you should potentially remember. Okay, so the time is right to talk about the actual features of fixed income instruments, and more specifically, actually debt securities in the form of bonds. We'll talk much less about loans, more about bonds here. Now, very helpful, I think, in such a discussion would be to illustrate the concepts with a timeline drawing on which we will try to graphically depict the different moments in the life of a debt security. So this is a time axis. And over here at the very start, I'm going to say that a debt security is actually created on what we call the issue date. So on this date, you're going to have the issuer. Sorry, that should say issuer. I was thinking ahead, trying to write investors, meeting with investors. Now, how that process of issuance actually works constitutes separate learning modules. Later on in the curriculum, there are separate learning modules for how the issuance of debt securities by governments works, how the situation looks like when it's corporate issuers. So there's a lot more learning to come here. But obviously, what will happen over here is that on this date, the debt security is created. Later on, we will often say that this is simply a bond. The debt security is created, it's issued, investors buy it, and they obviously pay money. So there's money going this way, and this is known as the issue price. Now, at the very other end of this time axis, we're also going to have an important point. This is the end of a debt securities or bond's life. We call this the maturity date, or simply the maturity of the instrument. But a word I will also use interchangeably with maturity is the redemption date. Now, this is important because, at least in the English language, what happens on the maturity date is that the issuer and investors meet again. Although when I say again, what's quite important is it doesn't have to be necessarily the same investors who initially bought the bond. After all, these are securities. So what will happen typically is that these securities will many times change hands because they'll be traded by investors. So the investors appearing over here will often be completely different investors who bought at the issue date. And they present the debt security, the bond, back to the issuer. And the issuer redeems the bond, they redeem the debt, hence the redemption date, hence that name. And obviously money flows this way. Now, what happens, or this flow of money, this cash flow, is known as the principal. And later on, I'll give you other names as well, like face value, par value, or nominal value. But what gets repaid over here is the principal. And this is something which is written into the bond document. You'll actually know upfront how much typically you'll get at the end of the bond's life. Now, how much do you pay for the bond initially? Well, the issue price may be the same as the principal, but it doesn't have to be. However, your book states that the issue price is typically equal to the principal, something that I don't necessarily agree with always, especially in the case of government bonds. However, just note that your curriculum states this, or your books state this, that this is typically the same as the principal. But there is a very important, still a very important piece of the picture missing from our illustration thus far, and that's the fact that over the lifetime of a debt security, we will often, not always, but often have certain systematic payments which are made by the issuer to the investors. Now, they can be of a level equal nature. They can be of a more sort of variable nature. We call these payments coupons or interest. And actually, the next video in this playlist is devoted to interest or coupon payments. This obviously happens on specific dates. These are called coupon or interest payment dates. And actually, when at the maturity date, investors receive what's known as the principal or face or nominal value or par value of the bond, You typically also receive your final coupon. Okay, so the final one of these payments happens also falls on the maturity date. I think this picture will aid us greatly when we now start discussing the different features, like who's the issuer, what happens on the maturity date, etc. But let me just note one more thing here. I'm just going to say it. I'm not going to write this down. How are fixed income instruments different to equity instruments? Well, first of all, fixed income instruments typically have a maturity date, although in just a few minutes' time, I will say that not all of them do. But there's typically a maturity date, okay? And very importantly, these coupon payments over here are a commitment made by the issuer to investors. They have an obligation to pay those coupon payments at a specific amount. In the case of equities, investors receive a dividend, but there is nothing guaranteed about a dividend. An issuer of shares doesn't commit to pay you a dividend. After all, in order to actually create a dividend, there must be a profit in the business, because dividends are essentially, from a legal point of view, a distribution of profits. So if there is no profit, there may also be potentially no dividend. Right. That question aside, let me write down the first parameter that I want us to focus on, and that is going to be the issuer. So, over here, the time has come to discuss the features, and the first feature is the issuer, and there will be plenty more to come. The issuer can essentially be any legal entity, and this legal entity could be a business, it could be a government, it could be a unit of local government, an agency, whatever, who's going to be responsible for making those payments to which we are committed under a bond agreement. So coupons, and then the payment of principal at the end, potentially at the end of the bond's life. However, we do group issuers into certain types or into certain categories. So let me say issuer types over here, and we're going to differentiate, following what's in the curriculum, into actually two categories. So I'm going to say over here the government sector, and on the right-hand side, I will write down private sector. Now let's begin with the government sector. Here we've got, once again, a bit of variety. We may have the sort of the central government, the national government. We also call this sovereign or a sovereign issuer. A lot of the time we also say treasury securities. Treasury securities are issued by the state treasury, so by the national government or the sovereign government. And the important thing to absolutely note, and this is going to stay with us across the whole curriculum, or at least its fixed income section, is that typically it is these national or sovereign issuers who present, typically, not always, there's always exceptions, they have the lowest credit risk, meaning they're associated with the lowest risk of potentially the investor not receiving the money back. And that's because, as we will later also talk about, national or sovereign issuers and their ability to repay their debt is backed by their ability to enforce taxes. And, that's the fiscal power of the government is essentially what backs these types of national debts. Now, also, under the heading government sector, we're going to have local government. So things like cities, states, various units of local administration. We often associate this borrower with the word municipal, with the phrase municipal. What else? You should know about certain supranational, so this is above national level, supranational organizations. And here we may have, for example, the World Bank as an issuer of bonds at a supranational level. And one more that your curriculum mentions also under the government sector is going to be quasi-government entities. Don't worry about remembering these, right? It's not something that you need to commit to memory, just something that you need to be aware of. Quasi-government entities, which obviously means kind of government entities. In various countries around the world, you're going to have certain agencies which are backed by the government or run by the government, and they may issue their own debt securities as well. Because they're part of the government complex, we treat them as quasi-government. Your curriculum also brings up the issue of, or the example of the postal service in many countries, for example, being part of the government complex, and that could be considered kind of quasi-government. But in other places, the postal service may be run as a privatized company. So that would fall under the heading private sector. Right, so moving here, under the private sector, we will definitely have corporate issuers, so companies. And that's quite obvious. This will also, for example, include banks, which are a big issuer of bonds. And additionally to this, and there will be more on this to come, something called ABSs, which stands for asset-backed securities. Now, asset-backed securities are not really the issuer. The issuer here is actually, maybe I should create this link up here and break this down, SPV. Okay, that's a better way to denote it. The issuer is the SPV, and what they issue is an asset-backed security. Issuer issues this. Okay, because we are talking about issuer types, it's more appropriate to talk about the SPV as a type of issuer. SPV stands for Special Purpose Vehicle. Another way to describe this, instead of using the phrase SPV, is to say SPE, where it's still special purpose, but we'll use entity instead of vehicle. What this is a specially set up company, and the job of this company, it just has one thing to do. It's to issue something called asset-backed securities. Later on, I'll show you how these things work when we talk about sources of repayment on bonds. But generally, what will happen is you set up a special company who's, it's special. It's specially set up for just this one purpose. That's why we call it a special purpose vehicle, or indeed entity. And what they typically do, these companies, is they buy up, for example, loans, mortgage loans, or any other asset that may produce a regular, steady stream of income, cash flows. And that income, those cash flows, are then the source of payments made to investors in ABSs. So the issuer is the SPV or SPE. And I think this covers the topic of issuers. Okay, so I've kind of docked the issuer feature on the left-hand side, and I now want to move on to the next feature or parameter. That's going to be the maturity date, or simply the maturity. And one thing we need to do is to define this. This is the date, obviously, on which, now very importantly, the final payment is made to investors. After the maturity date, there are no other payments that will be made. The instrument, the debt security, is essentially no longer with us. It's not necessarily the date on which the principal is paid, because as you'll see, I think 2 videos down the line, there are securities which pay, or maybe 3 videos down the line, I'm not sure, which pay principal not just on a single date, but across their lifetime. They're called amortizing debt securities. Nevertheless, this is the thing to remember. It's the date on which the final payment is made. And I want to introduce one other word, which is quite important and often associated with debt securities, which is linked to maturity, and that's the tenor. Now, different people use this word in a different way, so don't be shocked if you are used to this word being used in a slightly different context, but this is the time, or your curriculum defines this as the time remaining to maturity, and associated with this. So this is basically a time that's going to shrink as time passes, essentially. But I want you to appreciate that depending on the security's tenor as measured or as assessed at the issue date over here. So when a security is freshly being issued, depending on how much life there is ahead of it, so its tenor at issuance, we're going to classify securities into at least 2 categories, depending on whether that tenor is within or above a 1-year period. So those which fall within this 1-year period, the 12-month period, are going to be often referred to as money market securities. And these will include things like treasury bills. Treasury bills are government issued short-term securities with an initial tenor of not more than 1 year. On the other hand, and actually similar instruments may also be issued by companies, but then they're not called bills, they're called commercial paper. You'll learn about these later on when we discuss corporate bonds. However, everything else, everything that has a longer maturity is going to be referred to as capital market securities. The capital market is where issuers or borrowers obtain funding of a longer term nature. So capital market securities over here, and quite importantly, your book does, or your curriculum does make this point. This also includes, including something called perpetual bonds. Perpetual bonds don't have a stated maturity date. So no stated maturity date. That's an important feature to bear in mind. And they are typically issued, not by everybody, typically issued by, well, let's draw this over here. Governments. The UK government is one prominent issuer of so-called perpetual bonds, but also, but this doesn't have to be the central sort of national government. This can also be local government, but also banks sometimes issue these types of securities with no stated maturity date. So, I'm gearing you up for what potentially may be a theoretical question. And your book, your curriculum also goes on a little bit about these perpetual bonds and how they are different to equities, because equities also don't have a maturity date. So what's the difference here with these bonds, which also don't have a maturity date? So once again, just for the possibility that you'll get a question on this, differences to shares, meaning to equities. So the common thing is that they've got no maturity date, these perpetual bonds, but this is where I guess the commonality stops. These perpetual bonds contain no voting rights. Shares, naturally, at least common shares, give their shareholders voting rights. The second point is, in the case of bonds, the issuer has, a commitment to pay these coupons or interest/coupons, and this is not something you'll find with shares. Shares don't contain the issuer's commitment to pay anything guaranteed. And the final point is, and here we'll have for the first time the appearance of a new word, which we'll use quite a lot later on. Bonds, including perpetual bonds, have higher so-called seniority than shares, than equities. This is important in case of company liquidation. If a company goes, let's say, bankrupt and is liquidated, its assets are used to repay money to providers of funding. And holders of bonds, including perpetual bonds, will rank higher in terms of their seniority than holders of shares. Okay, the next feature which I want us to talk about is the principal. Now, I wrote that name down. Over here is something that is being paid on the maturity date. And over here, the issue price, I said it's typically equal to the principal, with some reservations that that's not always the case. Well, how is the principal really defined? It's the amount that's going to be repaid by the issuer. So amount which the issuer agrees to repay, but critically, on or, sorry, that should read on or before the maturity date. So if it's on the maturity date, it's just going to be a single payment, and we call such payments bullet payments. You'll learn about this in the subsequent learning module. If there are payments, repayments of principal before, that basically means the repayment is spread out over many dates, in which case you'll be looking at a what's known as an amortizing security. However, let me also write down over here that the principal is AKA, also known as, and we'll use these names, the face value of a bond, its par value, or simply par, or simply face. One more that you'll often come across is the nominal value, although your curriculum doesn't really use this one. Face, par, principal, these are the terms that the curriculum uses quite a lot. Now, okay, let's leave principal here. I'm not going to wipe this off. There isn't much more to say, at least in this learning module. Another feature, so let me put this down here, is the seniority, something I mentioned before. The seniority, what it does is it determines the priority of repayment. Now, normally, all bondholders need to be or should be repaid, but this becomes important in the case of issuer trouble, issuer, bankruptcy or liquidation. when the issuer of a bond gets into financial difficulties, who's going to be repaid? Maybe the money will not be enough or the funds available will not be enough for everybody to get a repayment. So who's first? So this is all about priority, but obviously priority relative to the holders of, to the other obligations of the issuer. Obligations of the issuer. And later on, we'll talk about the fact that some bonds are ranked as or are created as senior bonds, which come higher. Some are junior, some are secured, some are unsecured, etc. This is all to do with the concept of seniority. And there is one more parameter or one more feature that I want to discuss in this video. However, it's not the final one. What I want to write down is contingency provisions. I'll explain what that means in a moment. Contingency provisions. However, as I said, it's not the final feature because what we're missing from this list so far is the coupon. And because that coupon is such an important feature with so many different things that can happen there, so many things to discuss, I'll discuss it separately in next video. So for now, my list of features is going to close with something called contingency provisions, but by no means is this a full list yet. Contingency provisions are going to be clauses, so specific legal provisions written into the bond contract. So a clause which allows for a specific action, allowing for a specific action, so some specific behavior, in case of a specific event. I know it doesn't really sound like something very precise. In case of a specific event or a specific circumstance. And let me just give you one or two examples of this. The most common ones are going to be something called embedded options. Options which are optional features which are embedded into a bond. For example, a call option. This is something which we will discuss in a lot more detail later on, but it gives the issuer the right to bring forward the redemption date or the maturity date and repay the debt, repay the principal ahead of the official sort of schedule. We can also get a put option or have a put option built into a bond. It contains a similar right to accelerate the redemption, the maturity, but this time it's in the hands of the investors, the bondholders. They decide whether they want to exercise that option. There are also embedded options which come in the form of the possibility to convert to equity. So conversion options, meaning that when the this is conversion, when the maturity date comes, the investor may decide whether they want to receive a fixed amount of principal, for example, $1,000, or a certain number, once again, a predetermined number of the issuer's shares. That's something, a specific action in case of a specific event or circumstance, which needs to be specified in the bond contract in order for it to be then able to happen during the life of the bond.